I put this development model together because I've done a lot of development modeling, specifically like multifamily and commercial modeling throughout my career in commercial real estate underwriting and acquisitions. And the models that I've worked on had a lot of good components, but none of them have really had what I would like in order to quickly screen a multifamily development project. Um, and then, also go a little bit further into the analysis and be able to make a confident offer on the land that that you're looking at, and be able to go forward with your project. So that's what this model attempts to accomplish. It's a mixed use development model. It's primarily focused on the multifamily side of that development, but you can also incorporate retail or commercial, etc., into that project, making it a more mixed use development model. So what's included in this model? I've got 10 primary tabs. Those tabs include the Deals and Returns tab, which is a cut sheet or a dashboard of the major deal points. I've got an annual profit and loss statement. I've got a return on cost sheet, which shows the untrended return on cost for multifamily by itself, the retail by itself, and then blended. I've got the project assumptions for the apartments, which are the major inputs for the multifamily. Got the project assumptions for the retail, which are the major inputs for the retail. Got a construction budget, the financing schedule, which shows the funding and payments and payoff of the construction loan and the permanent loan, if you choose to put permanent debt on a development project. I've got an equity waterfall, which shows the cash flow distributions for the general partner and the limited partner. Currently, this is just one bucket for the general partner and one bucket for the limited partner. I'm working on incorporating an equity waterfall that can split the GP into a co-GP and then the LP into several LP share classes. But that'll be forthcoming. I've got a monthly profit and loss statement, which is really the engine of the model, where where all of the the major operational and financing cash flows are made, and all of those are then rolled up onto the annual profit and loss statement. And then the comp analysis, which is a place to put your rent and sales comps, and then also a competitive development pipeline. So moving through the model itself, I'll zoom out just a little bit to show the whole thing, and then we can zoom in here in a second to show more of it. The inputs in here right now are not flowing through. I'll take a look at that in a second. That's not what it's supposed to do, but take a look. The Deals and Returns tab is a summary statement, which shows the major points of the deal. So you've got high-level details, how much land you're buying, what's the price of that land, unit count that you're building on the apartment side, average unit size, total square footage, the type of product that you're building. This particular product is residential over retail. And it's just one building. You can detail how many buildings it's going to be here, the density that you're achieving, current rent, rent per square foot, stabilized rent per square foot. These are the retail project details. Again, similar data, how many retail suites you're building, the average square footage of those, total square footage, the retail income, expense recoveries, general vacancy and credit loss, and the average annual rent escalation. Development timeline, when you close on the land, when you're starting site work, when you're going vertical, when you're finishing construction, when you stabilize, and when you're selling. This model also incorporates condo sale capability, which gives you the flexibility to make early sales before your final disposition date. So some groups, maybe they're building a smaller apartment community. Maybe it's like 10 units or 20 units or something, and they actually want to condo off individual units. Or you want to do the same thing with your retail. So this model gives you the flexibility to do that. Disposition summary, so summary disposition information. This is net of condo sales. So if there are any condo sales, this will incorporate any of that sale amount and give you the valuation of your remaining units. Development budget summary, land and closing costs, hard costs and detail, soft costs and detail, and total project costs. Project returns, as I was mentioning earlier, some things happening where the IRR at the project level and at the LP level aren't flowing through. And I think it's something to do with the contributions and distributions, maybe flipped or something. I'll take a look at that in a minute. But that's summary information there. This is a cap rate sensitivity table. In this model, I split out the apartment cap rate from the retail cap rate. And so what you're showing here is the blended market cap rate for both components. And then you get your untrended return on cost, yield at sale, IRR, gross sales proceeds, sales per unit, and equity multiple. This is a summary sources and uses table. It shows the GP equity, the LP equity, construction loan for your sources, and it's being used on the land, hard costs, and soft costs. Here's some helper information over here to the side. These are GP returns pulling from the equity waterfall, LP returns pulling from the equity waterfall, project level returns, cap rate sensitivity. These figures here are housed on the deals and returns tab, but they flow throughout the model to make those changes. And then it gives you a blended market cap rate for both components, which ultimately controls your disposition valuation. Capitalization. This is capitalization really at closing, and then this is capitalization at stabilization. This isn't saying that you're raising more equity or you're raising more equity or anything. It's really saying what the value of the equity remaining in the deal is based on the debt that you choose to put on at that time. And then if you're not putting on stabilized debt, then this is going to show a full equity valuation still based on the construction loan remaining. So that is the deals and returns tab. I'm going to put it in print view for a second here. So print view gives you an easy print cutout that you can save as a PDF, or you can incorporate this into an investment deck. Just makes that part of this quantitative analysis a lot easier. So going over to the annual profit and loss statement. The annual profit and loss statement is just a great way to look at the operations and the financing and the total cash flows on an annual high level. Gives you an opportunity to analyze how your lease up is going, and how fast that's going. An opportunity to see how the retail income is flowing, your other income items, and all that. And these are operating expenses that are, again, flowing from that monthly profit and loss statement that we'll see here in a minute. Net operating income, return on cost versus your loan constant. And this is a good metric to look at because return on cost, once this figure flips positive, that's a good indication to you that you'll be in positive leverage territory. And so it's one of those quick ways to see if a deal is really a deal and if it's something worth pursuing. Debt service. So this number is going to change through the course of construction as you continue to add loan draws. Your interest expense from those loan draws will increase. And then once you flip to permanent debt, there's an option to have an interest-only period. That could be full term, that could be a partial term, interest only, just depending on what you're going to do. So you'll see that that debt service number increases depending on what stage in the process you're at. ODR draw, that is an operating deficit reserve draw, which looks at your cash needs through the course of construction and through the course of operations, both from an operations perspective and from a financing perspective, and it holds that amount up front in your construction loan, and then you're able to draw off of that in the future, so you have those cash needs covered. Then cash flow after debt service, levered dividends on contributions, refinance information, sales and disposition, sales and debt payoff information, and then cash flow from capital events. Yeah, okay. So yeah, one of the reasons why, on the deals and returns tab, we saw that this is flowing as zero, is because at disposition, the amount of debt being paid off, there's some interesting stuff going on with the permanent financing that we'll take a look at here in a second. It's one of the ways that you can really dig into a model and make sure that what you're hoping for is actually what's coming through. So that's the annual profit and loss statement. Return on cost. This is a really great sheet that I put together. It looks at your project development spread, which is a blend of the multifamily development spread and the retail development spread. So what that means is, based on the assumed income for a project, using today's numbers, right? Today's rents, today's other income, today's income deductions, and today's operating expenses. What would be your net operating income, if this project was fully stabilized today? So that number flows up here as your total untrended NOI. And then your total development cost, this is the amount of the project development cost that is being attributed to the multifamily. And I'll show that attribution in a second. But that gives you an untrended return on cost figure, and then the market cap rate for the apartments. So the delta there is your development spread. And then I've included a little checker here to say, okay, for multifamily, we want that spread to be at least 75 basis points. Some groups might say, well, we want that development spread to be at least 125 basis points. So if it doesn't meet that threshold or that hurdle, then this will turn red. Same exact thing for the retail. We've set this to a higher development spread for the retail. Maybe we perceive that income stream as a little riskier, or maybe we perceive the cost to build it as a little riskier, etc. Maybe some groups might look at it and say, we're really comfortable with retail. We're okay with a lower threshold there. We'll set it to 100 basis points. So then the blend of those two, the blend of those two comes over here and gives us our project NOI, our project development cost, our blended untrended return on cost, and then the blended market cap rate. That gives us a blended developer spread, and then we can set a blended threshold. Maybe we want that to be 100 basis points at the project level, or maybe we're a little bit more comfortable with doing this mixed use kind of project when we say, okay, we're okay with 75 basis points. So that's a threshold marker that you can set. Coming over to the project assumptions, I want to make sure I didn't miss any questions here yet. Okay, perfect. And for those who've joined at the beginning, I had mentioned that if you have any questions, you're more than welcome to put those in the chat throughout the course of this, and happy to go over those. If I'm talking for too long and I don't get to that question, please feel free to unmute yourself and ask it. So going through the project assumptions on the apartment tab, High level, you've got the date that you last updated it, the name of the project, project address. These are timing assumption items. So when you're going to start the project, when you're going to start construction after you've closed on the land, when you're going to start going vertical, the final certificate of occupancy. Um, this particular project assumes that you start leasing after the final CO. I know in garden style multifamily or in certain development projects where you have several different buildings, you could set it up to where you want to start leasing after the first CO. But this one starts after the final CO, gives you a little bit more of a conservative assumption. Um, because if you have to finish construction before you actually start leasing, then your income comes in a little bit later. To the extent that you did want that flexibility to start leasing after a first CO if you're doing multiple buildings, I'll probably make another iteration of that of this model that includes several delivery schedules. So I'll probably do that later. Stabilized physical occupancy, collection loss, revenue inflation, expense inflation, number of pre-leases, monthly absorption, lease-up concession if applicable, and stabilized concession if applicable. We'll look at the comps analysis here in a minute, but the reason you would include any of these is if, one, for lease-up, if there's a bunch of concessions going on in the market, or it's historically been a concession-driven market, you would want to include that in your analysis. And then stabilized concession, this has a bigger impact on valuation than the lease-up concessions because this directly affects your forward 12 NOI at the time of sale, which obviously impacts your valuation. So that's something to watch. It's important to include a stabilized concession if the market is concession driven. But to the extent that it's not concession driven, or you could reasonably suppose that the supply will be absorbed by the time you're delivering and you're ready for sale, that might be something that you can get a little bit more aggressive on. Turnover rate just deals with unit turnover assumptions, which affects gain and loss to lease and all that. So then the actual sale information, right? So you've gone through and made these other timing assumptions. The actual sale date is made here, which is just a figure that's a certain amount of months after stabilization. You could set this to a negative number if you wanted to sell prior to stabilization. Maybe that's how you operate your developments. This is the unit mix for the apartments. I've included a section where you can detail how many of these unit types are model units, which will take their income offline. The number of units by floor plan, unit square footage, monthly rent for that floor plan, etc. Other income, so other income, covered parking, detached garages, storage units, RUBS, which is utility reimbursements, smart tech package, other fees, and other ones that you choose to detail. Operating expenses, these are on a per unit per year basis. The only ones that are not are real estate taxes and management fee. The real estate taxes are controlled by tax assumptions over here to the right. And all this really does is you input the millage rate for the area, and it assumes 3 reassessments, one at acquisition, one at stabilization, and one at disposition. In the stabilization process, in between stabilization and disposition, this this will continue to slightly increase your taxes year over year until you get to disposition, at which point it'll switch to this one. And then the other operating assumptions management fee is on effective gross income. And these are just the operating expenses for the apartments. There's a separate module for the retail. For the construction loan, you've got loan term and months, which is currently set to either either the disposition date, if you don't have the permanent loan on, or it's set to whenever the permanent loan is funded, whichever one is earlier. Then the construction duration, which is just the length in between the final CO and when construction starts. Loan to cost, loan amount, equity requirement, interest rate, and debt service. But again, this is really just estimated information. The actual debt service flowing through is based on loan draws. And that amount for the construction loan is mostly capitalized at closing. For the permanent loan, this one can be turned off by zeroing out loan to value. The way the permanent loan is sized, it's on the lesser of loan to value, debt yield, and DSCR. So if you didn't want the permanent loan to turn on, you would just zero that out. And then the starting period is then tied to the disposition date, which is then flowing through with the construction loan. You can size this on trailing NOI or projected NOI, and the number of periods you want included in that annualized figure. This is the NOI that it gets sized off of, the cap rate that it gets sized on, the valuation, and then sizing metrics, the loan amount that actually pulls through, the interest rate, the loan constant, etc. So right now we'll just keep that turned off as we're going through here. This is the sale information, which is tied to this that we put up here. It's driven by when stabilization occurs. The NOI, the forward 12 NOI at disposition, the cap rate for the apartments, the cap rate for the retail, and the blended for the two, and then the value that pops through, and sales costs. Over here to the right, I've included a condo sales module. I won't get into like the particular of how this one functions. It's a pretty niche circumstance, when people are looking at a condo sale scenario. So if you are interested in the condo sale functionality, always happy to talk about it at another time. It's also included in the instructional sheet that I'll include with this model. Project assumptions for the retail. So this module includes up to 10 tenant suites. It includes a timing for when the lease starts relative to when the rent starts. The delta there is any free rent that's assumed. The reason for this difference is the recovery information is going to start along with the lease start. You can change that, and that'll affect when the recoveries start, but that's currently how that's assumed. The square footage for those individual suites, the length of the lease term for those tenants, annual percentage increases, and then the rent per square foot. This is expense recovery information. Really, the only important thing here is how much those tenants are sharing in expense recoveries on a pro rata basis. For triple net tenants, this is mostly going to be 100%. Full service, this would be 0. Any like base year stop or modified gross, etc., you could come in and just change that percentage accordingly. Downtime at lease renewal, free rent. Yeah, downtime at lease renewal and free rent at lease renewal. These are just at the first generation lease renewal. This model currently does not assume any second gen or third gen lease renewal, but these are just included there to help with the renewal assumptions. Again, this is the condo sale module for the retail. Really simple, just condo sale per square footage or per square foot, and then that actual sale amount, and when those sales occur. These are currently set to month 300 because it's pushed out, beyond the analysis period. You would just bring these into the into the month that you would want to assume the sales. Retail vacancy and credit loss currently set to 5%. I'd probably actually set this to 8% to include some of that credit loss. Retail operating expenses. Currently, there's not a ton in here. The way that I do these models is I don't love to add macros into them because I've found that they're often not not great for the end user. So the way that you add really anything into this model is I've made all of the formulas over here very dynamic. So you would just highlight a row, come in here, insert a bunch of rows. The shortcut for that is Control Shift plus, and then you would insert your operating expense here, the expense growth, drag all this down, and then drag the related formulas down, and it would include more expenses for you. Same thing with the income items above. Tenant improvements. These are the tenant improvements that are not capitalized at closing. So these are really at that first gen lease renewal. Or I guess second gen is the technical term. I've included in the construction budget a place to capitalize both tenant improvements and leasing commissions at closing for that first gen of new leases. These are for the lease renewal scenario. So oftentimes these TIs at lease renewal are very low. Sometimes they're zero, sometimes they're $5 a foot. I've just included a place to make that assumption. And then the same thing on the leasing commissions. Oftentimes the first gen is somewhere between 5 to 8%. On the second gen, it's usually like 2 to 5%. So that is the retail module. This doesn't include all of the assumptions that I would make in like a strictly commercial development model or a commercial acquisition model. I would dive into those, more of those second gen leasing assumptions and the third gen leasing assumptions, and make those a little bit more dynamic and tailor more of the model towards the commercial aspect. But this model is great, and you could use it for strictly commercial development. It would just have some more simplified assumptions relative to what I'll include in a future version. For the construction budget, I'll zoom in here a little bit. So you've got your hard costs and you've got your soft costs. If you were wanting to add, anything into this section, essentially what it's driven by is I do some stuff on square footage. For the leasing commissions, I do that on lease value, etc. And those are then brought over here into the middle for anything that's like a calculated amount. For anything that's just strictly an input amount, I just include over here to the left, and that flows over. These are the actual total costs that are being incurred in the construction budget. Right, so you got your total hard costs, sums up everything up here. And then really the inputs apply down here in the soft costs. A lot of the soft costs are just easy inputs. So any easy inputs, there's nothing here in the middle. Any calculated amounts, I usually do split out a separate calculation here, and then that flows over And then, you have your standard contingencies, so owner soft cost contingency, hard costs, GC fee, development fee, all that good stuff. Land, so the amount of land that you're buying, the cost per land foot gives you that total land cost. Some groups have they have like some land allocation that they like to do. So anything that you want to net out of that gross land value, you could include a negative amount here, and that would spit out your net land valuation that you want to pop through. So over here to the right is where the cost attribution is made. So for the majority of the cost attribution, I just do it on a pro rata basis based on square footage. But for certain things like the, I think this is actually moved down one, which is unfortunate. I'll get to that in a second. But for certain things like the like the vertical construction for the multifamily, I want all of that cost to flow to the multifamily. Or for things like retail construction verticals or retail TIs, retail LCs, etc. I want all of those costs to flow over to the retail. So I zero that out for the multifamily. So all of that then flows down here below to give you the total cost for the apartments, for the multifamily, and then the total cost for the retail, and then the associated actual attribution or cost attribution for those product types. The GC bid drop reference only. It's just a blank sheet. It's just a spot to drop a GC bid if you've received that. Financing schedule. So this sheet here gives you a place to detail what costs you want included at month 0. Currently that's set to just the land, but if you wanted to let more costs flow at month 0, you could do that. Again, the the equity is being spent first, and then the loan is being funded after all of the equity has been spent. So then once the loan starts drawing, then you get loan draws, which adds to your loan balance, which increases your interest liability, and then that's you're making interest payments through the course of construction, and this payment is being capitalized at closing in the closing budget. If you are assuming a permanent loan, then the funding and the payment schedule and the payoff amount of the permanent loan are going to flow through here, and then the associated payments are going to flow through here. These are cost curves down below. Really what this is doing is it's saying based on the construction duration, give us a cost curve that's being calculated down here below. And then that's the actual cost curve that flows through. And the reason why cost curves like that matter is it impacts the timing of when dollars are spent, which subsequently impacts your project IRR. Equity waterfall. Again, this is currently set to just one general partner bucket and one limited partner bucket. I'll be splitting that out in a future equity module or equity waterfall module. That includes a co-GP and several LP share classes if you want that flexibility. But right now, this is just kind of your basic waterfall. This is a place to control IRR hurdles, a place to control promote, and then that gives you your subsequent splits. I've also built in the amount of equity that gets split, assuming that you the amount of equity that gets split at disposition, assuming that you meet your hurdles. This is the monthly profit and loss statement. So this is really the engine of the model. I won't go through every little bit in detail because that would take way too long. But the basics of it is we're having our construction costs flow through. We're getting our cost distribution, unit delivery schedule, units leased schedule, which again, yeah, that comes over here. And after all of your units have been delivered, then you get your leases flowing through. And for those that have joined late and didn't hear, this is the way the model is currently built. Some groups like it to where maybe you're building several buildings and you want an accelerated leasing timeline where after you've delivered your first units, um, uh, then you're um, able to start leasing there. So I'll work on a modified delivery and leasing schedule for that too. As far as rental income, occupied units flows back to the absorption schedule, then physical occupancy, and all of your other income metrics. That gives you, well, your net retail income also flows through on this section to give you your total net rental income. Then you've got other income items flowing through, and then your operating expenses flowing through, debt service and operating deficit reserve draw, future tenant improvements for the retail, future leasing commissions for the retail. These are some lender metrics, debt yield and DSCR, refinance information, sales proceeds and disposition information. Construction costs flowing through again to give us our total free cash flow after construction and after operations and financing and all that good stuff to give us our IRR and our multiple on invested equity or the equity multiple. These are the tax calculations, what's flowing through at acquisition through the course of construction, what's flowing through at stabilization, and then what's flowing through at disposition. This basis remaining information here relates back to the condo sale scenario. So that is the monthly P&L. I've also included some conditional formatting up here to show, when the land closing occurs, when you're in the course of construction, operation period, stabilization period, disposition, and then post-disposition realized information. And then the last tab is a comps analysis tab. This is a place where you can put in your sales comps information, your rent comps information, and then your construction pipeline. All of this will help, inform your rents on the rent side, your market cap rate on the sale side, and average sale per unit that you should kind of be targeting. And then the construction pipeline can help inform concessions and relative rent levels that you want to be at. So that is that's the basis of the model. I've used a lot of development models in the past, and I really like this one. I feel like it provides a nice, clean way to take a GC's bid on a particular on a particular parcel, or go look at a particular parcel and kind of size up, what you want to do there, what you think could be, the highest and best use of that site. Take something like that in 30 to 60 minutes. You have a confident timeline, a confident, construction budget and rents and operating expenses and stuff, and be able to go make a confident offer on a piece of land and be off to the races. So that's that's what I have for you. Real quick um, while we're chatting here, what I'll do is I'll stop sharing here for a second. I'll include a link to my website where this model can be purchased. And then if you have any questions about it, anything that I can answer, I'm more than happy to go over that now. More than happy to go over that privately, whatever you want to do. And at this point, if you have any questions, you're more than welcome to unmute yourself. We went through this, faster than I anticipated, which is great. Always glad to get stuff done faster. But yeah, happy to answer any questions at this time, or we can break. Okay. Well, thank you everyone for joining this morning.